Hey everyone, I'm Andrew Constantinidis with Neil Jesani Wealth Management. And on the topic of REITs, one of the primary reasons that investors seek out REITs is because of the high dividend that they typically pay. Certainly higher than treasuries and even higher than investment grade corporate bonds. So that's a main benefit is the high income they generate. Of course, your trade-off for that income is generally you're going to have lower growth or lower capital gains in real estate, at least historically. But it's really important for an investor to understand how each individual REIT manages that distribution process and how they're taxed, because different funds do it differently. And there's some strategies to take advantage of to make sure that the tax liability is managed properly, whether it be the right type of account to have it in. Sometimes a qualified makes sense. Sometimes even a non-qualified account makes sense, which I'll talk about in a moment. And you also want to make sure you're not generating too much income, especially if, as an investor, you're already in a high tax bracket. Now, the three ways that those distributions are taxed are: one, as ordinary income; two, capital gains; and the third one, ROC, or return on capital, which I'll get into that one in a moment. But probably the most important, of course, is ordinary income. Because if you have a business and you're in a high tax bracket, let's say you're in the 35% tax bracket, well, that additional income that you're generating is, of course, going to be taxed at 35%, which, remember, you're kind of trading off some of the growth or capital gains potential from a REIT, which right now, long-term capital gains is 20%. So you could end up being taxed at a much higher level on that income. But there are strategies, and this is where it really takes a certain amount of due diligence into each REIT and their accounting practices to really mitigate a lot of that tax liability. So the first one is depreciation. So I discussed earlier that REITs depreciate the assets within the fund. So let's assume that one particular fund generates $1 million in income or earnings essentially for that particular year. Well, 800,000 of it comes from actual earnings or rental income. But for example, 200,000 of it may come from them depreciating the assets within that particular fund. In that scenario, the investor would certainly pay ordinary income tax on the 800,000. However, the 200,000 would not be taxed as ordinary income in that particular year, and instead that would be taken off of the investor's cost basis to go into the fund, which would result likely in a higher capital gain at maturity or during the exit strategy or when the investor decides to exit the fund. So that can be one way to mitigate taxes, is the way that they depreciate the assets within the fund. Because, of course, again, if you're in a high tax bracket, it's better to pay more of the 20% capital gains than more of the 35% ordinary income tax. The second way is the return on capital. So there are certainly REITs out there that qualify over 90% of that distribution as return of capital to the investor. So this is kind of in the same scenario as the depreciation, whereas let's say you receive $1 as a dividend and 95% of that qualifies as return of capital. Well, you're only going to pay income tax on that particular year on the 10 cents that is not return on capital. However, that money that they're giving you as a distribution as return on capital will again take away from the cost basis of the original investment and therefore increase the amount of capital gains that you will likely have when you decide to exit the fund. So it's very, very important to understand the different types of taxation, because let's say it's a fund that does count 95% of that dividend as return on capital. In that scenario, it's probably going to make more sense to have that particular investment in a non-qualified account where you only pay the capital gain when you decide to exit the investment, as opposed to, and again, especially if you're in a higher tax bracket, paying the income tax every year in a non-qualified account. So in that scenario, it's important to really do your due diligence and understand how a particular fund is taxing the investor and the tax treatment of the dividends to make sure it's in the right account and that you're investing in the right particular funds based on their accounting principles. So again, every investor scenario is a little bit different. This really needs to be tailored to your current income. So if you ever have any questions about that or would like an analysis, certainly give us a call. Again, my name's Andrew at Jesani Wealth Management, and I can be reached at 954-800-8552. Okay, thanks everyone, and take care.